So now that we have talked about scamsters and fraudsters, okay, let's keep that aside. Now let's see what are the next big things that have happened in the crypto space. So first of all, let's once again explain what fundamentally cryptocurrency or Bitcoin is. It's just money. What is Ethereum? It's programmable money. Now, the first thing you do after having money is you got to invest in it or you have to get some form of a yield for it. Okay. So that is where lending and borrowing comes into place. Regularly, when you have money, you go put it in a bank, you deposit it in a bank, the bank lends it out to people who need the money and they pay interest. The bank keeps a portion of it and gives it to you. It's as simple as that. Okay. So the first thing is you have money, and the next thing is you will have lending and borrowing on top of money. So there are multiple platforms and processes that have come in the crypto space like that, okay, which is about lending and borrowing crypto. So some of the most famous companies in the lending and borrowing space in crypto are Celsius, Voyager, Nexo, BlockFi. These were the from the centralized space, okay. Now there is decentralized lending where there is no company in between. You put your money into smart contracts. Smart contracts, they auto execute. So you send your money to a contract, it is lent out in a pool, people pay interest, you get a piece of it. So there's Aave, Compound, these are examples, DY by DX. These are examples of decentralized lending platforms. Okay, now these are legit businesses. End of the day, the centralized entities and the decentralized entities, they are serving a purpose. Like you have crypto, you want to get some form of a yield besides just price appreciation. So you put it on a platform where they find people who want to borrow crypto. Now, there are different ways you can do lending and borrowing, just like as a bank does it. You lend to people, you get collateral from them. That's called collateralized in the sense. So I'm going to lend you $100. You're going to give me $200 worth of crypto, which is because you're doing that to protect your deposit. In case Bitcoin's price comes down, you can sell this Bitcoin and you can give the depositor their money back. That's why this piece is there. Very, very natural business, exactly like a bank does. Now, the problem that was happening was many of these lenders did not collect enough collateral. Right? Now, there it becomes a risky business because you're betting on the balance sheet of the company or that company not going bankrupt or bust at that point. So here in this case, so Voyager is a company that collected a lot of money and they lent it out to 3AC, Voyager lent it out to 3AC. Now, what was 3AC doing? So 3AC was taking this money and investing or putting it into Anchor Protocol. Now, what was Anchor Protocol doing? Anchor Protocol was this protocol that was saying that if you invest Terra Luna over here, we're going to give you 19% interest. Now, 1 Terra USD or USD Terra, the stable coin, it was an algorithmic stable coin. It was saying that you put the money here, we're going to give you 19%. Well, most people were not asking the question, where are they giving this 19% from? This is like I'm just telling you, hey, you invest in my company and you buy this Nithin coin, which I'm telling you is worth $1. You invest over here, and I'm going to give you 19% of Nithin dollar. Well, where do I give it from? So I'm printing it. All right. When you print money, the money should be worth less. So behind the scenes, when you go into something like this, it all starts from stable coins. So you had Bitcoin initially and you had Ethereum, two cryptocurrencies that are doing phenomenally well, which is money. And then people are saying that they want to get stable money because the price of Bitcoin and Ethereum are fluctuating. All right, so people build something called USD Tether, USDC, where two companies, Tether and Circle, they used to collect dollar from people, put it in a bank or commercial paper, and they used to issue a token which you can use instead of a dollar, and you can redeem it for your dollar value with the company. That's centralized stablecoins. There, the principle obviously of cryptocurrency is being decentralized. So here you have a centralized entity. So then MakerDAO and DAI comes up with a concept where you can issue a dollar equivalent of a currency using smart contracts and over collateralized assets. So I can put $200 worth of Ethereum in the DAO contract, in the MakerDAO contract, and get issued $100 worth of DAI. Every time the Ether price goes down, there's going to be a margin call, and they might sell my Ether and, you know, protect the whole dollar peg. This is this is called collateralized Ether or crypto collateralized smart contract based stablecoin. There, the problem is to get $100 worth of money, fiat money, you had to put $200 worth of Ether. So it is an over collateralized position to protect the underlying asset. There, the people were saying it's an inefficient use of capital, which is true. It is inefficient use of capital, but then that is protecting the capital. So the holy grail of these things in stablecoin is getting algorithmic stablecoins into existence, where you have nothing behind the scenes and it can create a stablecoin. Multiple companies have started or tried this out. Basis to many companies tried it, but all fail because there'd always be a glitch in that system because you're creating this out of nothing, right? And it is the holy grail of stable coins if it can happen. It just hasn't happened. And Terra Luna was the biggest success because at one point they had $60 billion under them, all right? And poof, one day when there also it becomes a belief system. And when the belief system is broken and the peg is broken, and it happened due to multiple reasons, okay? We can get into the reasons later. The whole thing crashed and people's investments went to zero because a lot of people took that bet saying that, I bought the US dollar equivalent. It is just an equivalent, doesn't mean that it's always going to be staying pegged to that number. Once it breaks down, there is no equivalent. So all those interest rates broke down. So in the Volt case, or in many of the Voyager case, they were investing into these protocols. See, think of it. They are a company that is telling you that if you invest over here, we're going to give you yield. To get the yield, they have to lend it to somebody. Now, who do they lend it to? They can lend it to short sellers or to exchange arbitrageurs. Those are some of the people they can lend to. And then there is this option of staking and yield and this anchor protocol. So they will invest over there also. When they break down over there, these guys, these companies that do lending and borrowing, it's not like it's their money. People are depositing the money and they have to give it out for lending. And they collect a very small fee. So if you give me $100, I lend it out to somebody and I charge 10% interest, I have to give you 8. So what do I really make? I only have $2 with me, but I have to protect your money. For some reason, if the lender doesn't come back with my money, I still owe you 100, or maybe 100 minus 2, or 100 plus 8. Where do I get that money? So this is a very big possibility when you're in the lending and you see bank runs or banks going bust or banks lending to some company like Kingfisher. They lend money to Kingfisher and Kingfisher just went bust, right? That is an example of banks doing lending and borrowing. And if they don't have proper controls or doing proper credit checks and understanding the business, there's a heavy chance of that happening. So that is more like, that is not a scam or a fraud at that point. That is like lending without taking proper precautions of collateralizing what you're lending or what you're giving for, okay? Because everybody's trying to get yield. The person who gives more yield obviously will collect money from individual investors. Everybody wants the individual investors' money. Every company is trying for that because the bigger the amount. So I'm in business. It doesn't make sense for me to do a $100 business. My time and effort is the same whether I do 100, 1,000, 10 million, 100 million, $1 billion business. So what I'm trying to do is get to $1 billion as quick as possible because by that 2% that I make becomes a large number of money for me. Many times when we do this, people who are doing it are sometimes not exactly aware of the risk. All right. So Lehman Brothers, Bear Stearns are an example in the stock world. Very prestigious companies. Those were number one companies that people wanted to work for when they got out of graduate school or undergrad in finance before 2008. And in 2008, when they went belly up, what happened was they were having leverage or they were borrowing at short term, lending at long term. And when short term rates spiked, they couldn't service their deals or they couldn't sell their deals. And they had so much toxic stuff on their balance sheet. Same way, when you're doing lending in the crypto space, many of these companies lend it to people who they thought were extremely smart, or they showed, basically people sold them ideas that we can get you better yield, but they didn't know exactly where they were getting it from. And the end result was the 3AC Capital, who could collect money from all these guys, whether it's Voyage or Volt, Galaxy, Genesis. They collected money from all of them and they just put it into Anchor Protocol. And when Anchor Protocol went bust, none of these guys could repay the loans. Means 3AC could not repay the loans. And the guys who lent it to 3AC, they did it without collecting collateral. See, this is where the problem is. They did not collect collateral because they believe that 3AC is this awesome company. Their founders are good. They're super brilliant. No matter how super brilliant you are, you need to collect collateral from your client. Otherwise, things can go belly up. That's why, brokers, once upon a time, India, brokers would fail. Why? They were not collecting enough margin money. So when you are doing a trade for somebody, you have to collect the margin money because they need not show up tomorrow. And at that time, you will be on the hook. So same way here, what happened to these companies like the Celsius, Voyager, Nexo, or